Welcome out to the Blue Sky Trading Lab. This week with Coach Matt, you guys were working on reversal analysis part two. Yeah, last week when we talked about kind of the basics of reversal analysis. What are the types of reversal patterns, the primary basic mainstay ones. This week we're going to get into a little bit more of an application conversation, I would say, when it comes to reversal analysis. And so, just by way of review, let's quickly review kind of the reversal patterns by nature, and then let's get into kind of the context of what we're going to be talking about here today. Like we talked about last week, there are three basic types of reversals, guys. You have double top, double bottoms. Those are the M and the W's. So whenever you hear the word M, whenever you hear the word W, M stands for murder, W stands for winner. Winner, winner, chicken dinner. And so those are your basic reversal patterns, MWs. The second type of reversal pattern that we want to work on is the head and shoulders, and then the inverted head and shoulders. And then the third one is commonly referred to as the V-shaped recovery. And so you have your double top and double bottoms, you got your head and shoulder types, and then you have your V-shapes. Now, in every reversal type pattern, you also have development of what is called a continuation pattern. And I want to talk about the key differences between the reversal versus the continuation. And then I want to go to the market right now and I want to talk about the couple patterns we saw over the last couple days to identify where we would have got in, where we would have put a stop loss, where we're looking at how to position, and so on and so forth. When you're looking at the traditional double top and double bottom analysis, these are the easiest reversals to really kind of track. You're talking about the simple variations of support holding and resistance holding. Now, if you'll remember, when you're dealing with bullish uptrends, guys, and this is where we're going to get into a little bit of drawing here. When you're dealing with bullish uptrends, a bullish uptrend is nothing but a series of higher highs and higher lows. Higher high, higher low. Higher high, higher low. That's how bullish trends are, or the patterns within the bullish trend. And we identify the 1, 2, 3 pattern where 1, you break out, 2, you get overextended, and 3, you pull back. Well, at the end of a trend, you're going to see certain things happen to help us understand that we're coming to the conclusion of a trend. Now, if you'll recall, last week we talked about one of those things being the momentum of the trend. Identifying slowing momentum is a precursor to the end of the trend. Now, when you are looking at a bullish uptrend, you never want to get into the kind of front run reversal analysis. You never want a front run reversal analysis because you don't know until you actually come to a proper conclusion of the technical story. And so as you're seeing nothing but higher highs and higher lows, higher high, higher low, if that's the only thing we're seeing, we're just going to trade bullish. That's it. As long as that trend is bullish, we want to trade that trend. Now, what we will start seeing in the backdrop of, to kind of talk about the momentum side of the equation, when you look at a situation where you have this big upward movement in price followed by a shallow upward movement in price, what are we going to start thinking when you see that type of pattern? When you go big upward movement in price followed by a shallow upward movement in price, what do we call that, guys? Technically, what do we refer to that as? This right here. What do we call that? You guys tell me. What is that referred to as? When you have a big upward movement in price in wave 3, followed by a smaller upward movement in price in wave 4. It's called slowing momentum. It's called slowing momentum. When momentum slows, it puts you on the radar for the end of the trend. Now, F, you never want to get into the point where you put the cart before the horse here. And saying it's going to reverse is putting the proverbial cart before the horse there. It's just slowing momentum. Exactly, XO. It's just slowing momentum. Slowing momentum is an indication that the previous trend is coming to a conclusion. That's the only thing it tells us, that the previous trend is coming to a conclusion, that you're lacking buyers because the buyers, they bought here, they bought there, they bought here. Are they really going to reassert their willpower to create momentum next? No. And so you're starting to lack buyers, you're starting to lack the momentum, and you can assume that you're coming to the conclusion of the trend. No doubt about that. What you cannot say and what you cannot determine at this point is whether or not that pattern, or excuse me, that trend is going to develop into a reversal pattern, such as an M formation, or if it's going to develop into a cup and handle formation, which is a continuation pattern. And that's what I want to talk about here. And so when you're looking at the differences between two patterns, okay, you have the traditional M formation where you have that big upward movement in price, then a smaller upward movement in price, and then you basically come to the situation where you come into all the way back down into support, and it creates the M formation. And when you create the M formation, you basically have a probability at this point for the next trend to be what? When we see the double top and double bottom, where we have horizontal support and resistance at this point against the backdrop of an uptrend, what do we think the next trend is going to be? We think it's going to be a bearish downtrend, Gabber. Right. You're right. We think it's going to be a bearish downtrend because we're seeing that M formation. But there's one key point into this, guys, because look, when you think about a continuation pattern, for example, you get the same type of trend, you get the same type of momentum. The key difference, though, is, oh, excuse me, that getting a little too big there. The key difference here is what happens at support. So if, for example, once you hold here, right here, so once you hold right there, let me get a different color here, right here, once it holds right there, the trend is over. It's over. Once resistance holds, trend's done, trend's over, buy. You cannot look to the previous trend. Once resistance holds, that trend is over. Because what is the definition of an uptrend, ladies and gentlemen? Higher highs, higher lows. That's the definition of an uptrend. So in general, in an uptrend, resistance is constantly broken. Constantly. Resistance right here. Resistance right here gets broken. Resistance right here gets broken. Resistance right here holds. And so once resistance holds, the trend is over. But once resistance holds, and I say this in our stream quite a bit, you don't have the information necessary to determine the next trend yet. You just don't. Because what tells us what the next trend is going to be is not simply the slowing momentum. It's not simply because the market double tops right here. So if the market double tops right there, once again, that is a terrible line. So let's do it again. What does it tell me? The moment resistance holds against a bullish uptrend, what does it tell me? It tells me one thing specifically, and just one. What is that one thing it tells me? Once resistance holds within the backdrop of an uptrend. First of all, it tells me the bears are there. That's what it tells me. It tells me exactly APM, 100%. 100%. Everybody write that down. Trend's done. Trend is over. Now, APM, do you have the information necessary to determine the next trend at this point, though? Not yet. So does it matter if the last trend was really bullish and you made a lot of money in it? Does that matter? Or does it matter if the last trend was bullish and you lost money in it? No. This is a new situation. This is a new trend. This is a new pattern. This is a new development. That stuff's old stuff in the past. We're laser focused on this price right here because you have two patterns that are continuation patterns. So the first pattern we're talking about here is the M formation. It stands for murder because the previous uptrend is over. Now, that is a reversal pattern. And that reversal pattern is pivots are equal. That's the entire concept. Pivots are equal. Okay. So you have horizontal support and horizontal resistance. You have horizontal support, and then if it works down into horizontal resistance and horizontal support. So once it comes into the previous pivot within the trend, this is now a reversal called an M formation. Your pivots are equal. Why do we see it through the bear lens when pivots are equal? Because pivots weren't equal through the entire previous trend. And now that they are equal, the question you have to ask yourself if you're a bull is, why didn't we see an increase in support? Because it's the increase in support that tells you everything here, guys. Everything in a reversal versus a continuation pattern is identical up until this point. Everything is. You have slowing momentum typically. You have to have a double top for the end of the trend to occur. The difference is what occurs at support here. And so if support comes all the way down to the previous area of support, that is a reversal because the most likely scenario we're going to see is that. Now, if support doesn't do that, but it comes down, 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 but then it increases. If you see support increase, what does that tell me? See, everything about understanding price, guys, is understanding the eternal battle between buyers and sellers, understanding the eternal battle between bulls and bears, supply and demand. And it is supply and demand and the bulls and the bears that drive price. And so if you increase support here, who still controls price action? That's the entire game here in day trading, guys. Understanding who is going to control price. If support increases, that's the buyers are stepping in to increase that support. It has nothing to do with the sellers. It's all about those buyers stepping back in to defend the price. And so as support increases, we are still looking at it through the bull lens. We are still looking at this through the, support still increased. So even if horizontal resistance occurs, what do we see this? It's just profit taking. It's just a little bit of hesitation in front of the next move. That's how the entire market is going to see it, guys. They're going to see it through the lens of that increase in support saying buyers still have control, demand is still occurring, we still have room to run. And not only that, but technically speaking, an increase in support, think about the last time. It ran from right here all the way into resistance, came right back down. But now you're running into resistance on a shorter porch. And I want you to think about price as this. I've given this analogy before, but I'm going to give it again because I think it's extremely important. How many of you, if you went outside right now and you ran just a mile as fast as you could, what would you do at the end of the mile? You went out and you ran a mile as fast as you could. What would you do? Okay, XO's fainting. Gabber's like, beer time, beer time, beer 30, baby. Okay, panting or breathing. I'm going to tell you right now, I'm probably laying down. I'm probably laying down. I'm probably like, oh my goodness, that's too much. It's too hot. It's too cold. It's too everything. I'm out of shape. I got to run more. I'm never running again. That type of thing, right? So that's if we go run a mile, okay? But if I went outside and I ran 10 steps, would I have the same level of exhaustion? Would I have the same level of mindset? Would I have the No, I'm not exhausted if I just run 10 steps, right? So think about going into a breakout like that. In this first attempt going into the breakout where the breakout held, it ran, and just let's go on my fake numbers on the right hand side here, it ran 5 points. Okay. So you ran 5 points before you got tired and you came right back down. Well, if you're going to make that same run, we know the market can run 5 points before it gets tired here in this pattern. Well, if you make that same run, that same 5 points is now a breakout. That's how important the market is. The market is focused on all of this average movement of the past. The past dictates the future. And so if I know the market can run 5 points in this pattern before resistance stops it, and I'm coming from a higher threshold of support, that same 5 points breaks me out and continues the trend. Does that make sense, guys? That's why the increase in support is so important, is because if we see an increase in support, every projection tool out there will have the market as in a breakout type situation. And so in that scenario, let's kind of come back here. There we go. Now, if that does not occur, but we come all the way down into support and we double bottom, double top, that next move, that next 5 point move, it just comes right back up into resistance. It does not break out, which means the probability starts shifting. Once you come into support here, now you no longer have bulls have any control of trend. It's flat out neutral. And anytime the bulls try to insert their willpower back up, they're just going to get hit by resistance unless they get a catalyst. But you don't want to trade in that scenario where unless they get a catalyst, I need a catalyst to win. I need a catalyst to win. You don't want to be in that scenario. And so if you come all the way down into support here, you are now a reversal pattern. And the most likely scenario is support will hold initially, and then that pivot takes it out. And so what will occur a lot of times is you see this market go up, 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 and then it pivots here and right back down. Now, when you come into the market here, and we'll go into the market here in a second. I want to show you a couple of historical reversals to show you how this plays out over time, but on longer term charts. But I also want to come into the intraday side of the equation and talk about it from a day trader's perspective. Now, the opposite of the M formation is the W formation. Now, the W formation stands for winner. And what you'll notice, guys, is bullish patterns have a tendency to be named as positive things. Bearish patterns have a tendency to be named as negative things. You have the M for murder. You have the W for winner. You have the kiss hello. You have the death cross. You have the kiss goodbye. You have positive and negative names, but they're just naming rights. Now, as the market is bearish and it goes down, 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 we'll just take it from this level here. So give me a second. Let me see if I can erase some of this stuff. Are you guys good on the M formation, kind of the key points? Is everybody good on the M formation? Pretty simple pattern, simple construct. Really, the difference is what happens within the development of the support level. That's the end all be all of absolutely everything. Oh, Amazon had a mixed report, by the way. I don't know the raw numbers yet, but they did have a mixed report here. Okay, so basically, let's erase all of this one and let's talk about the W formation. Now, the W formation is a bearish downtrend. Lower low, lower high. Lower low, lower high. Shifting momentum puts us on the radar for the end of the trend. And all of a sudden, we get the double bottom. Now, once we have the double bottom, what does that tell me about the previous trend? Once support holds in a bearish downtrend, what does that tell me about the previous trend? It's over. It's over. And if it's over, should I tap on the brakes a little bit if I was actively shorting this trend? Should I maybe it's a yellow caution sign? Of course. I need to pull off the aggressiveness, right? Because at this point, do I know what the next direction is? I don't. I do not have a probable edge as of yet. As of yet. Now, as the market goes up, 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 and then pivots back down. So we still have a decrease in resistance. We still have that decrease in resistance. What are we looking to do here? We're looking to short because our expectation is the bear still had control. And in totality, the only thing we're seeing in this pattern development is a continuation pattern. By the way, this is called an inverted cup and handle. If it holds one additional time and still sees a decrease in resistance, can anybody tell me the name of that pattern? I want to test you guys here. No Googling, no chat GPT. Somebody, FF, everybody tell F, congratulations. It is a descending triangle. Yes. And so you have the descending triangle. You can also call it a falling wedgie. But in technical terms, it's a descending triangle. Okay. And so the inverted cup and handle and the descending triangle, are they pretty much the exact same pattern, just one takes a little bit longer in development? They're pretty much the exact same pattern, guys. Okay. They're some of my favorite too. They're some of my favorite too. I love time consolidation and pattern development. Like like when we're going through the concept of is this a continuation or is this a reversal? The best reversal patterns have time components to them. And anytime you can get an additional pivot within the construct of the continuation or the reversal, it does nothing but make the analysis better. Because on the longer term, like what you don't know in the pattern development is you got these moving averages that are lagging the price. And the more time you can buy in the actual construct of the pattern, those moving averages get underneath the pivots and they start flatlining, like the momentum, like the 5 EMA, the 9 EMA, the 13 EMA, the 20 SMA. They start flatlining. And so when you break back up or you break down, you got a really good moving average conversation there. And so that's a story down the road. But yeah, I do love the descending triangle, the ascending triangle. I like them a little bit more than the cup and handles, and that's just because it's buying a little bit more time. But the key point is, guys, regardless of the name of the pattern, if you hold 4 times but resistance still holds. Resistance still contracts. If you hold 5 times, but resistance still goes down. If you hold 6 times, but resistance still goes down. It doesn't really matter how many times it's tested. The key point is as long as resistance is going down, who has control of price? Regardless of the horizontal nature of support, as long as resistance is going down, the bears have control of price action. And if the bears are going to have control of price action, I don't want to fight those grizzly bears. They can get mean sometimes. I might as well just jump on their back and ride it like Putin did that one time. And so we're looking for the breakdown here, ladies and gentlemen. Now, if we don't see the decrease in resistance, but we see it work back up into the upper levels of resistance. Now, what do we have? We have the W formation because the story is now one of neutrality. So why is it though that if the previous trend was bearish and we're now seeing neutrality, why am I seeing that through a bullish lens? Why do you guys think? You would think you would just see it through neutrality. Why do I see it through a bull lens? The story's very compelling, guys. The very Aren't the bulls in a bearish downtrend just kind of patiently waiting for the bears to be done? And so isn't that like the sign to all the bulls that the previous bearish downtrend is now over? And now all the bulls who have been waiting to do something now have their edge. And so now they're all those bulls, guys, they're all now closer to their screens. They're now looking at a lower time frame. They're like, okay, where do I get my edge? Where do I get my edge? The very second you don't decrease resistance, bulls get excited. The very second you don't decrease resistance, bulls will take that and try to run with it. And so now you have that W formation. Now, oftentimes, guys, as the market is working back up into resistance here, here's what I love seeing in a reversal. One, increase in support. If you have a shallow pullback against a reversal pattern, I love this so much. This is one of my favorite things to see in a reversal because it tells me the story. All of a sudden, you're now in neutrality, but you have an increase in support. The only thing that would increase in support is for those bulls. The bulls would be pushing the edge. Bears got smoked on that. Bulls get excited. That's a front run going into a breakout. And then the breakout, we get momentum. Okay. So the W formation is simply one where we are tracking the pivot points. And the very second we see that go right back up into resistance, we no longer have a bearish downtrend. We no longer have bearish control, and we're simply tracking that next pattern on the breakout. Okay. Are we all good on the W formation? Awesome. Okay. Now, the third, or those are two, one's bullish, one's bearish, but those are the basic ones. All right. Now, the third type of pattern you have here is what we call the head and shoulders. So the third is the head and shoulders pattern, or for the bears, or excuse me, for the bulls, the inverted head and shoulders pattern. Now, tipped, I saw that this previous weekend. Pretty funny, bro. Pretty funny. And I think South Park's just kind of getting started with all that. It was pretty funny. All right. Now, the head and shoulders formation. We don't need to draw all the previous trends. We're just going to focus on the formation itself. So, does slowing momentum play a role? And what I'm talking about is the slowing momentum within a trend. Does it play a role in every construct of every pattern out there, whether it's a continuation or a reversal? The answer is yes. Okay. That is a hallmark technique to look at the end of a trend in every single time frame of trend. The slowing momentum concept. So assume we have slowing momentum. Now, what a head and shoulders formation is it's a bullish uptrend that comes to a very abrupt ending. Now, a few weeks back, it might have been like 5 or 6 weeks at this point, I talked about a conversation called the depth of the retracement. And we talked about it through the lens of Fibonacci analysis of the momentum pullbacks, the standard pullbacks, and the deeper pullbacks. Anytime you get a deeper pullback, and what a deeper pullback is, here's your shallow, that's the 21% Fibonacci. There's your standard, that's the 50% Fibonacci. That's your deeper. So a deeper pullback still increases support, but a deeper pullback puts it on the radar for a head and shoulders formation because the deeper pullback, it's very difficult to go back up and break that resistance. It's very difficult for that to even get into the range of that resistance. And so the very second you decrease resistance here, all of a sudden, who has control of price? The very second you decrease resistance. MJ, it is recorded, yes, and we'll post it to our YouTube channel on BluSky, most likely this weekend, my friend. So again, when we decrease resistance, who is controlling the price action? Bulls or bears? Bears are. Now, but we don't trade in the construct of the pattern, guys. Correct? Like when the pattern is developing, do we get aggressive inside pattern? Yes or no? No. We get excited when it breaks the pattern. Okay? Does that make sense? Like I don't get excited here. You still have an increase in support, guys. You still have an increase in support. So you have an increase in support because of the increase in pivot. You have a decrease in resistance. That's a battle. You don't want to fight that battle. Isn't this whole game just trying to figure out how to jump on the winning team's hand? Like, isn't that this entire game called trading? Is to jump on the winning team and to ride the winning team. That's our entire purpose. We're not bulls. We're not bears. We don't buy the hats. We don't wear the jerseys. We don't get emotional. We don't do that. We wait on the winning side and we jump on the winning side. It's almost like the bulls and the bears play trench warfare and pattern development, and they're just taking shots at one another. And you, me, and a couple dudes are just up on the hill waiting for the winner to be declared. And then we just run down and celebrate with them. We don't know who's going to win that inside the development of the pattern, guys. We don't know that. When we know that is when the pattern gets broken. And when the pattern gets broken is when you break this support level. And inside a head and shoulders formation, that, my friends, is called the neckline. And so when you connect your pivot point to your pivot point in a head and shoulders, we call that the neckline. And so what you have here is over here, historically, this will be considered the left shoulder. Excuse me, that will be considered the left shoulder. The slowing momentum in the trend is considered the head. The deeper pullback to the decrease in resistance is called the right shoulder. And then when you break your trend line, that's called the violation of the neckline. And that is your tradable signal, is right when it gets under the neckline or the pivot point. Okay? So in a head and shoulders, I'm going to draw it again. In a head and shoulders, let's go back there. In a head and shoulders. There we go. Okay. In a head and shoulders formation, when do I take action? Do I take action? This is your first one. This is pattern number one. Do I short it when it lowers resistance, or do I short it when it breaks support? Two. Which one? The lower level of resistance or the violation of support? It's all the support, because when you break, guys, there's no retracement you trade in a pattern development in a reversal versus a continuation. There's not a pattern that you're looking to trade on a pullback, guys. Every single aspect of reversal versus continuation analysis is breakout analysis. Every single degree of it. There's no pullback. You can front run stuff in pullbacks, but the reversal versus the continuation conversation does not come to a proper conclusion until we actually violate the pattern, meaning we break a support level and thus the neckline within the head and shoulders. Now, on the downside, guys, we deal same type of thing, same type of pattern. You got the market going down, loss of momentum, deeper pullback, excuse me. We got to go down one more. And then we do the deeper pullback, shallow retracement, coming back up. To draw your neckline, you simply connect your last two resistance pivots to draw your neckline. And then when it breaks through your neckline, that is your tradable signal right here. Now, historically, you see the left shoulder over here. Here's the head. Here's the right shoulder. The increase in support is based on the deeper previous retracement. And so in a head and shoulders, you always get a deeper retracement. It always happens. In a head and shoulders formation, the deeper retracement puts you on radar for a potential reversal there. Now, the last reversal we get, and let me fast forward a little bit here. The last reversal we get is what we call the 1, 2, 3 pattern, or the V shape. The V shape recovery is basically the head and shoulders without the left shoulder. It's a very aggressive pattern. There's not a lot of time components in it, and it looks extremely bearish until it isn't. And what I mean by that, on the 1, 2, 3 V shape, on the 1, 2, 3 down, it looks extremely bullish until it doesn't. Now, what it is, guys, and again, we should review the depth of the retracement conversation, because it's a very important part of this entire discussion. But if you recall, in a retracement situation, there's certain levels that we track to help us understand the momentum component of a bullish uptrend. So let's say right here is a motive wave up. Motive wave up. So we have our motive wave up. It goes from 115 up to 155. So what our job to do, if it gets overextended, is to track this pullback. And as the market is pulling back, there's going to be these key levels. One at the 21% level, one at the 50% level, one at the 61% level. And as the market comes down to the momentum and it pivots here, what am I thinking? If it pivots here, what am I thinking? If it pivots in a bullish uptrend against a 21% pullback, what am I thinking? I'm not only continuation, Gabber, like on a scale of 1 to 10, 10 being ultra bullish, 1 being zero bullish, we're full port longs here. We're picking up the big stick to try to hit something big out of the park type situation. Now, if it pulls back to a standard level, I'm a little bit more cautious. Okay, I'm a little bit more cautious. You gave up a little bit more. I'm going to ask for a little bit more. On a 21% pullback, you get that pivot, boom. You don't even have to see it confirmed. Just get above the number and you're good. On a 50% pullback, you have to see it confirmed. Now, the problem on a deeper pullback is it's going to take a tremendous amount of momentum for this trend to continue. Because for this trend to continue, you have to break the highest level of resistance. You have to run all the way back up in and then ask it to run on top of that. That is a tall ask. That's a lot to ask for a market to do without doing something else first. That's just a lot to ask. And so, well, not only that, it would be a partial, yes, RQ, but even to make the trade, you're not going to just want to see a pivot point up. You're going to want to see a little bit of this number, a little bit of just consolidation, and then it break back up. Because if you don't get that, you're running into the 90 MA and you're going to get blasted every single time. And so a deeper pullback, guys, is a nasty sign technically. It is a nasty sign technically, because oftentimes it will start running up, get caught on some longer duration average or some longer duration level, and all of a sudden it pivots down. And so if you look at it's worse than an M tipped, because it is an M, but you didn't even have enough muster to get back up into resistance to create the M. Does that make sense? Like, it's even worse than the M, because you have that lower level of resistance. And it is very aggressive on the downside, guys. Very V-shapes are nasty patterns on for the bulls. Now, the ultimate question though on a V-shape is, where do you actually take the trade? Because simply because we lower pivot Think about the head and shoulders again. When you have a increase in support pivot, but a decrease in resistance pivot, are we aggressive in that scenario where we're decreased resistance, but we're increasing support? No, 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 no. What we like is when it comes down into that support, test it, and then break. This is the tradable situation when it breaks the pivot point, but it's very aggressive, very aggressive. And so when you come into the market, I want to talk very quickly about just some of these patterns historically. Now, I know, and we'll take a look at the pattern here in just 1 second, guys, but I want to go back in time a little bit. And I want to show you some patterns in history. Okay. Now, do you guys all remember the subprime meltdown? By the way, these patterns, the things that you're learning on the continuation versus reversal, do they work on every single time frame? Yes or no? Yes, they do. Yes, they do. Okay. Different traders, different time frames, they work on every time frame. Now, you're looking at a weekly chart on the S&P 500. You're looking at the years 2005, 2006, and 2007. Now, in 2008, we went through the subprime meltdown where the S&P 500 lost 57%, 401ks went to 201ks, and it wiped out an entire generation of wealth in America. Now, how many of you actually went through that as a trader or as an investor, or you had a 401k or whatever the case might be? And I know a lot of you didn't because you were probably still in junior high then, or high school, or college, or whatever the case might be. But I'm willing to bet that a lot of you had people in your life that did go through it. And I was thinking about your parents, F. I went through it myself. Okay. I was a trader then. I was an investor then. I went through it myself. But my parents, specifically my father, got hit pretty good. Now, my mother didn't. My mother's a cutthroat person. She's an assassin. Like, you don't want to mess with her with money. She'll beat you up a little bit. But my father's old school. And my father got beat up pretty good in this one. And the simple reality though is I was begging him to do something about it. Not in 2008, guys. Not in 2008. I was begging him to do something about it in 2007. And he wouldn't, because I was a new trader. I'd only been trading 2 years at that point. He had an advisor. And what was his advisor telling him? His advisor was telling him to stay the course. The man was 60 years old. He was a few years from retirement, and he was told, stay the course. Well, we all know what happened next. The subprime meltdown occurred, and the market gave up 57%, and an entire generation who wanted to retire, including my father, couldn't. In fact, how many of you know somebody in your life that had to go back to work in the 2010s because what occurred in the late 2000s? It does kind of look like today's chart, kind of like technical analysis. Doesn't matter the time frame there, RQ. Now, reversal analysis starts with what concept? Well, not reversal, but the end of a trend. What is the first sign we typically see at the end of a trend? Before pivots, before we get into all that resistance versus support, what do we typically see? Slowing momentum. Okay. Now, remember, there's two ways to determine slowing momentum in trend. One, you look at the actual wave count itself. And so the wave count goes from support to resistance. And so the wave count goes from support to resistance. Now, that's the first wave. Now, here's wave one, here's wave two. They obviously contract. Now, the second way to do it is to look at the breakout channel. Is so you go from where price broke to where it ended. You go from where price broke to where it ended. Can everybody see the slowing momentum? Okay. Now, when we see slowing momentum on any time frame, does that automatically say that the market's going to reverse and we need to go full port short? No, it tells us we need to slow down. It's a yellow light. It's not a red light. It's a yellow light. Could be green next, could be red. I don't know, but it's a yellow light right now. Now, as the story goes on in the subprime, and you fast forward in time a little bit here, well, what occurs? Do we get a double top? It's not the cleanest, but do we get a double top? Market tests back up, can't break, come right back down. Once that holds, by the way, that's October of 2007, guys. The slowing momentum occurred in the spring, early summer of 2007. All of this was before 2008, guys. Every ounce of this was before 2008. And so when you see that, you're like, okay, resistance holds. And when resistance holds, what does it tell me? The very second resistance holds, what does it tell me? The very second on any time frame. This one's a weekly chart, but could be a daily, could be an intraday. The very second resistance holds, the previous trend's over. It's over. Now, we don't know the next trend. No, we don't short yet, guys. We don't short yet. Okay? The best trade you hunt. The absolute best trade you hunt. There's no doubt about that. The only thing you know at this point is that the bullish uptrend is over. That's it. The bullish uptrend is over. Now, am I getting a little bit prepared to short? Am I getting a little bit excited maybe to short? Am I getting into the frame of mind to start breaking down where I would short? Yes, of course. Of course, right? But you don't take action yet. You just get ready. Again, you're hunting that. You're hunting that trade. Now, as the market comes down into support, once support holds, what pattern do we have? We now no longer have an increase in support. What pattern is this now? It's an M formation. The very second support is equal against equal resistance, that is a murder formation. That is the M. Now, as we see the M, what did I tell you guys? Oftentimes, once you get the M, you're going to see this retest back up, but the very second you lower that threshold of resistance, oh, now it's game on. Bears have control. All this while, all this time, bulls had control. Now you have that decrease in resistance. The bears have control. That decrease in resistance was in December of 2007. Then you violate support, which is the tradable signal. So once it gets under support, that's the signal. This, when you hold, you get excited. When you lower resistance, you start front running. When you break support, you do everything you can to short the market, basically. Now, see the market now go down, 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 down. Okay. Now, on the retests of resistance, is that the question? Because that's the next shortable signal in this reversal. It's called the kiss of death, by the way, on the retest. Everybody write that down. KOD. Everybody write it down. Kiss of death. It is a nasty pattern. It is a nasty pattern. Now, what it is, and Think and Grow Rich, you're basically stating exactly what it is. It's that retest of the resistance level. So when the market breaks support, establishes a lower threshold of support, goes back in and retests that breakout channel, this is the kiss of death. It comes back in, kisses that, and after that, guys, it's over. Like market buy, sayonara, everybody and their dog shorting until they say we can't short any longer. And so even on a longer term, and by the way, the .com guys, if I did this on .com, it played out the exact same way. The only one that really didn't was pandemic, and the pandemic one was obviously unique. Now, That's on the longer time frame. I just wanted to show you that consistent one. Now let's come down into the intraday side of the equation and let's look at the ES yesterday. And let's tell the story on the 5-minute chart now. Now, yesterday was a very interesting situation because I think from a day trader's perspective, it's a little bit different than when we're looking at longer term zones because your levels play a lot here in day trading, obviously. And yesterday, when we got our Fed induced spike to the downside, it was really fast until you started working into this level right between the 63.70 and the 63.80 zone. And when we came into that level yesterday, I made the statement in the stream is I said, guys, this is a level we have to track. This is a level you have to track because you could see a reversal here. You could see a continuation pattern here. The reason I said that is because you were coming into the zone of this pivot point right here. And so you were coming into that pivot point right around the 7.5 level. And that's that zone of support. Now, it's not going to be clean because we were dealing with the Fed. We were dealing with a lot of volatility, but that was the zone. And that was the reason I made the statement I did was, okay, this is the zone. I want to track the development of patterns. And when you look at the 5-minute chart, we were looking at this story being told. And I kept saying yesterday, I said, okay, the technicals are telling a story here. They're telling a story here. Let the story come to a conclusion. And I remember people, oh, buy here. Oh, buy here. And I said, no, bears still have control. Bears still have control. Why do bears still have control at this point? Right? Anywhere right here. Why are bears still having control here? Well, number one, you're below the 9 EMA. Any development under the 9 EMA, guys, is going to be seen as bearish. Any development against the backdrop because you still have decreasing resistance levels. Look at the wicks, look at the bodies. Everything's still decreasing. As everything is still decreasing, you're seeing the bearish move there. And so what I said yesterday was, guys, you got to be a little patient here. But as it gets above the 9 EMA, what changes? The momentum starts changing. And once you start working back into your pivot point, and you had a pivot point at 85, right where the bodies are, and then you got a couple wicks there, but I looked at the pivot point at 85. Once you got above 85 and you confirm above that level, what do you have? A W formation that then therefore got confirmed. And then once you got confirmed, guess what the 9 EMA started acting as? The same way it was acting as resistance in the downtrend, it now acts as support in the uptrend. And so the story on the intraday side is going to be a little bit different because everything's a little bit quicker. But that 9 EMA is an extremely helpful indicator in helping us understand the difference between continuation and reversal on the intraday side of the equation. So if it's going to develop underneath the 9 EMA, what are we going to see it as? Bearish or bullish? If the pattern is going to constantly develop under the 9 EMA, it's going to be seen as bears. And the very second we get above the 9 EMA, what happens? We shift. We shift. The pattern shifts. The probability shifts. The bulls start thinking they have a little bit of a better shot in that pattern development. Now that was done on a 5 EMA, and then obviously we got the Meta, Microsoft news, and the market was up, and didn't even pull back. It just based up, base up before we ultimately got the market we saw all the way today. Now, let's look at the market right now, this very second, with the same type of conversation here. Now, let's look at the market here on the 5-minute here. Okay. Now, as long as resistance lowers, who has control, guys? Yeah, I think I like that pattern too. Like we were talking about that yesterday, and that was once it consolidated, broke back up against the 9, bulls had control. Okay, so is resistance still decreasing? That's the first question. Is resistance still decreasing? Kinda. Kind of, I would say. What do you guys think? When you look at this overall price structure, is resistance still decreasing? Yes or no? I'd say yes. I'd say yes. Here's a pivot. There's not really a pivot here, although you do have a pivot of support. And I do see this as a little bit of consolidation at this point. So resistance is still decreasing, but can you see also that the momentum is shifting a little bit? So we still have decreasing resistance, but we do have momentum shifts here. And as you see those momentum shifts, are we starting to see this more through the consolidation lens? Okay. Now, when you have that situation, guys, there's no real edge in between those levels. Okay. I call this one more of a K trade. It's called a K. Yeah. I call this a K trade setup where you are equally willing to take the bullish breakout as you are the bearish breakdown. That's how I see this. When you have like just simple consolidation against the backdrop of slowing momentum, I see it through a K trade analysis. Basically, you break resistance, you're a buyer. You break support, you're a seller. I don't see this as like a prototypical reversal yet. I don't see it as a prototypical pattern yet. Just given the fact that we have a little bit of volatility here, you come out to a longer time frame. See if we can clean that up. All right, longer time frame, 15-minute chart. Does it clear it up for us? Yes or no? What pattern are we looking at here? This is still a bearish pattern. Has the market had the ability to break up above the 9 EMA on the 15-minute chart? It tried. Couldn't hold the water up there. So the 5-minute chart is consolidating, K trade. The 15-minute chart has slowing momentum, but no pivot relationship as of yet. So should we see this as a bullish reversal or a bearish continuation pattern? What do you guys think? Steep pullbacks in the nine are called nine slappers tipped, and they're very, very good patterns. Again, I still think K trade here. Like the pivots are not telling you a compelling story here yet. The pivots are telling you if on one side of the ledger you can make an argument on the bull side, on another side of the ledger, I think you can make an argument on the bear side, which means you have to see something. What is it you have to see here? You have to see it confirm one way or the other. I would say in general, consolidation against the backdrop of a bearish downtrend is seen through bearish lenses, Nacho. But in general, anytime you're consolidating against any like you can't say this is a continuation or reversal pattern. You have to have pivots in reversal pattern analysis. You have to have pivots in continuation analysis. And so what you're really just seeing is consolidation. And consolidation is seen through the lens of neutrality. You can see it either way, but you have to see a confirmation candle. That you have to see that. Like you can't do anything unless you close above the 9 EMA. You can't do anything unless you close underneath 6360 because you don't really have a pattern here yet. So simply because you have consolidation doesn't mean you have a pattern. Does that make sense, guys? And that's why you see it through the lens of neutrality. If you have a pattern, you have pivots, and pivots tell the story of who's controlling price action. But in this situation, we just don't have that. You have pretty much volatility, little up, little down, little sideways. You're looking for confirmation here. There's no doubt about that. All right, guys, like I said, I really wanted to do a lot of whiteboarding today, just kind of really working on the mindset difference and the pattern difference between continuation analysis and reversal analysis. Did you guys like that today? Was that helpful today? Awesome, awesome, awesome. Oh, RQ. Oh, RQ is not the edgeless anymore. Oh, look at that. Look at that. I love that. I love that. RQ. Let's talk a little bit about those key earnings, and we're in Q&A period right now. But I want to take a look at old Apple. Take a look at old Amazon as well. Apple's going to gap up, guys, from the raw numbers. I haven't looked at their actual earnings yet. We've obviously been talking here, but on the overnight action, obviously we're seeing a little bit of a pump here. Tested that 215 level before he came right back down. That's the resistance pivot, but it looks like we got a raw number beat here. Numbers out of Apple. Yeah, slight beat 157 against a 43. Slight beat on the revenue side of the equation. Big beat on iPhone revenue. iPhone revenue pretty decent, quite frankly. iPad revenue was a miss. Was a miss. Product revenue was a miss. Service revenue slight beat. Gross margin slight beat as well. Um, Apple CEO Tim Cook says it was an exceptional quarter by any measure. Tim Cook, I would say it is not an excellent quarter in comparison to Google, Meta, or Microsoft. Lam Research. I would say I would not agree with you, Tim Cook, on that statement. I think there's a lot of measures that this was not an exceptional quarter. You got a mixed report on the raw numbers. And if it was truly an exceptional quarter, you would be doing more than just kind of volatility shaking in front of a conference call. Oh, CEOs who make stupid statements simply to get price bids drive me crazy. I hate it. It drives me nuts. It's like, what do you mean by any measure? We just saw Meta. Meta had the absolute great, amazing, beautiful, standout report. And now Tim Cook, who can't get AI right, is saying it's an exceptional quarter by any measure. No, by one measure, iPhone sales. Every other measure, you were lukewarm, if not average, Tim Cook. My goodness. Like people can't read those raw numbers. You're in line on everything. Slight beats, not even beating the market average. My goodness, that was ridiculous. Um, he's going to have to say AI a lot more. A lot more. And he's going to have to do more than say AI because most likely they're going to have to buy AI. Oh, just silly statements like that, Tim Cook, get people like me just being like, what are you talking about, bro? Like, seriously. Like, we can't see the other results. Amazon. Amazon. Mixed report on Amazon. Amazon came in at really good EPS beat, 168 against 133. Revenue was a $5 billion beat. They're printing money over there at Amazon, 167 billion against 162 expectation. We're obviously dealing with the guidance situation here. When you got substantial beats like that, but you have downward pressure on price, that's always a what are you going to do for me in the future situation. I'm assuming their guidance was lowered. I'm trying to read their guidance. Hold on, I'm trying to find it. Says they have an increase in guidance on the revenue side of the equation. Slight. It's very slight on Amazon. Oh, oh, I see where it is. AWS. Oh, AWS. That's the Azure for Amazon, that Azure is for Microsoft. Amazon Web Services had 18% growth versus Azure at 39% and Google Cloud at 32%. That's a negative number in comparison. Mixed report. I would describe it as a mixed report in general on Amazon. Expect a gap down on Amazon. Apple could be testing some interesting resistance levels. Like I'm very critical of Apple because Apple should be better on the AI side of the equation than they are. They should be better on R&D than they are. I'm not going to complain, but they should be better on that stuff. Um, but Apple could be a very interesting technical conversation if we're going to be dancing 215 here tomorrow. That's a pivot point of that is very well known, very well known. So Amazon a little bit down tomorrow, Apple a little bit up. market should not have a tailwind one way or the other on a mixed report here. Huh. Interesting. Interesting. Um, well, that depends. And that depends. Like for me, when I'm looking at the ES tonight, like I see this as consolidation, certainly, K trade, which means I'm trying to find the trend line here. Give me a second. So you got this trend line here that's punching down pretty hard, but you got this little bit more methodical trend line right there. All right, so okay. Yeah, this level right here, this 80 level, that's something to track here tonight. That's going to be a very interesting level. If we consolidate, break back up that on the Asian hours, I will like that. Any break at 30, 60 is 63.60. Is it shortable? Any break 63.60? Would that be shortable? Yes. Very clean on the downside here. Very clean on the downside. You can see it on almost every time frame. Very clean on the downsides. Even on the 1 hour trend, like that's very clean on the downside there. So, but Apple and Amazon certainly not providing anything here. All righty then. Did you guys have fun today? Awesome, awesome, awesome. All righty. Well, I trade with Thinkorswim, 8 p.m. If you're in the money, I'm happy. Awesome, RQ. Full port long lab. Let's do it all. Let's do it all. Which one was? I'm trying to find his specific question. Give me a second. I got to go look at the chat over there because I wanted to answer his question. Can somebody post it? I can't find it. Is that why I can't find it, RQ? Oh, it was on Tesla versus TSLL. Um, yeah, the reason I said on basically I was talking about a straddle strangle bidirectional trade on Tesla is what I was talking about. And I basically said I don't think you have an edge. We were talking about it yesterday. I don't think you have an edge, but I kind of like the bidirectional situation here. And I was saying that because volatility is low, options are low. You can kind of see it on implied volatility. Whenever implied volatility is at the low end of the cycle quarter to quarter, you're definitely looking to be a net buyer of options. And the reason you're looking to be a net buyer of options because when volatility is low, volatility helps options. When volatility is high, it hurts options. And so you're really looking to trade buy long strategies when volatility is low, short strategies when volatility is high in the options market. Like for example, a credit spread is a short strategy. You're selling options. A covered call is a short strategy. You're selling options. Naked put, short strategy. You're selling options. So you're just either buying or selling options. So number one, I was looking bidirectional here because I didn't feel like we had an edge directionally on Tesla, meaning I couldn't determine are we gonna go up, we gonna go down. I just expected movement. That's really it. I just expected movement and I wanted to get in front of the movement. And so what I talked about doing was the concept of a straddle. or otherwise known as a strangle if you're going to do offset strike prices. And so a straddle is when you go out in time and you buy the same strike price. You buy the 30, and I'll just show you guys on the risk graph here. So let's go to Tesla. We'll add a simulated trade and we'll do 78 days. Okay. You want to do more time when you're doing straddles and strangles because you're holding long options that theta works against you on both sides of the equation. So if you buy, let's just say strangle, okay, because that's what we were talking about yesterday. And let's move down our price slices and there. And we were going to do, let's say, the 270 on the put side. So 270 on the put side, and let's go out of the money here because we were doing a strangle. Just to show you the risk graph, we'll do the 365 on the call side. Okay, now when you do something like this, guys, the reason you do this is because on the risk profile, you basically have a situation that looks like this. Let me take those off. For some reason, we're not scaling here yet. Okay. Let's delete that. And let's add simulated. All right, so we're going to buy that one. And we're going to buy this one. There we go. Okay, so now you can kind of see the risk graph here. It's called bi-direction because when you buy a call and a put, you lose money if the market stays neutral. You make money if the market expands either up or down. And so I was looking at a strangle play on Tesla because of the implied volatility was low, was expecting volatility was expecting, I can hold him. Yeah. Oh no, he's good. Thank you. I got the little dude on my lap here, so he might talk to you guys here in a minute. So basically, you're looking at the strangle or the straddle play here. You do it because you expect movement to go up or movement to go down, and you want to get involved before the movement starts happening, and allows you a lot of decent management options, quite frankly. Now, the reason I said I prefer it on TSLL, which was the question I was asked, is because the cost to get into this trade in the option side of the equation is going to be about $2,000 a contract. And I just felt like if I was going to do it on Tesla, I would rather do what's called a debicon, which is basically, buying the out of the money call option or out of the money put option, but selling a deeper out of the money put option, creating a spread. And so a debicon is a spread, whereas the other is a single. And if you do it in a spread, the cost is relatively cheap in comparison to doing it as a single because you're selling options to bring in cash flow. And so the reason I said I preferred doing the single one on TSLL was because number one, it was the cost structure perspective. It was just cheaper to get into the trade per contract and allowed me more management, more ability to get to scale in and scale out on that. That's the only reason I chose TSLL. And that was the question that was put in by Anon was TSLL versus TSLA. And you do TSLL when you expect a little bit more movement. You do TSLL when you want to be a little bit more cost conscious on the contracts. It allows you to do more contracts, gives you more management options. That is the answer to the question. But with that said, guys, you guys want to say bye to the little boy? I got the little boy on my lap. This little dude's going to learn how to trade. See, look, he's telling you all about it. You want to tell the team all about it? Huh? You want to tell the team all about it? You're going to be trading crude oil in no time, aren't you? No, we're going to start this little dude on gold. This little dude's starting on gold. He's going to start on MGC. That's what he's starting on, huh? We already talked about it. I talked to him about it last night. He couldn't sleep, and so we talked about MGC all last night, didn't we? It's going to be a good starter for you. All right, guys. I had a lot of fun here today. Thank you so much for coming out and supporting the Blue Sky Lab. And if you love it, tell somebody about it and tell them to come out and hang out with us every single Thursday as well. And with that said, guys, I'll have the recording up. Hopefully, tomorrow I'll get it to McCarm, but if not, I will get it to him over the weekend. I hope you guys have a wonderful, wonderful rest of your day. And hit me up, guys, if you need anything. Thanks, team.